we find that invariably at trend change points, tops or bottoms, that momentum will usually, almost all the time, lead price in terms of defining a trend change. In other words, breaking down or turning up. It'll usually happen on a momentum chart before it'll happen where everybody can see it on the price chart and get excited. You want to be there before everybody else gets excited, right? Now, generally, we look at things on a fairly long-term basis. We don't care so much about the day-to-day. Now, we also cover all four major asset categories. Now, by that, I mean the debt markets, foreign exchange, especially the large foreign exchange, dollar, euro, for example, commodities, but with an emphasis on gold and silver, and the stock markets. Now, why do we look at so many things? The reason is obvious, has been a long time obvious to us, that there are many times that if you're in a given market and focused on, let's say, a stock or a sector in the stock market, you've got to be aware that other icebergs are floating around out there, other asset categories. And it's not just what you think is going on with the stock market, but what's going on with the debt markets, foreign exchange, commodity prices. How will that impact your stock position? And those are external factors, but they're very real and very big. So you really need to look, no matter which market of those four categories you might be heavily invested in, at the other categories, because they'll impact your category. Now, sometimes that connection is sort of loose, where if interest rates go up a little bit or down a little bit, it won't affect stocks or something, but there's times when it becomes acute. And, we're one of those times now where everybody's focused on what the world is the Fed going to do down the road. The topic of conversation right now is focused on the Fed as if Fed is God. And we know full well that, yes, the Fed can have your back for some time, but there's times the Fed totally collapses in terms of its potency. Witness 2000 to 2002 bear market. They did what they could to save it. It didn't help. 2007 to 2009, they did what they could to save it. It didn't help. And similarly, most bear markets start like arm wrestling. It's not real clear who's winning. If the Fed perceives and the public perceives and investor asset managers perceive that the stock market is risky, we better start moving assets to other categories, which they're already doing, by the way, then the Fed has a problem because the stock market could affect all those little economic numbers they're looking at, unemployment and so forth. And so any talk of tapering out the window. If anything, it's going to be more foot to the pedal. What's interesting, when we measure the alternative markets, and right now the two best alternative markets to the stock market are what? Gold and T-bonds. It was certainly true as the market collapsed last year and prior to that. What does that signal? It says to us that probably large asset managers who've been around a while, not novices, don't chase trends. They're skeptical at times, sometimes the appropriate time. Guys like Ray Dalio, who's warned us, don't be so worried about the price of your stock. Worry instead about the value of your money. Guys like him who are not gold bugs have shifted assets, no doubt, not lots, but marginally, let's say, over to safer places to be. And I see the evidence now in what the bonds have been doing and what gold's been doing. So that indicates to me that large asset managers who are skeptical have begun to move slices of their assets from one to another. Now, if the stock market starts to get more overtly weak, you're going to have more of that because they got to go somewhere. And it's obvious that if they're buying T-bonds, they're not buying it for yield. They're buying it for safety. And they're buying gold because it's a leader of the inflation event. It led the commodities up 2 years before they even turned up. So anyway, I think that's going on. And that's another reason why you should look at all four asset categories, because they'll impact each other. Ultimately, the Fed may create the river flow, but investors as a class divert the river flow to where they want it to go. Now, in 2009, at the bear market low, when the S&P had been cut in half, the stock market was arguably cheap. In fact, we got very bullish on the very bottom week. We said major low, not because we love stocks, but the technical said this is it. That was the end. At that point in time, then the river flow that the Fed had already been creating, but which did not stop the big bear market, went into play. And so people bought a lot of things. They bought the stock market and they bought gold as well. And for the next several years, gold went up more than the stock market. They were coincident at the time. But in 2011, they divorced. Gold peaked, went down, S&P continued on up. But at that point in time, it worked. The Fed printing money worked because the market had been cut in half. So investors perceived less risk, greater reward. But now we've been going up a dozen years and you have this upwardly curving chart off the page, one of the oldest bull markets in history, no doubt supported all along the way with easy monetary policy. But the question is, will investors and asset managers perceive this to be forever upward? Or are they smart enough to know, no, there's times that, the Fed doesn't control, because they look at history and they know. They were there in 2000, they know the Fed tried, it went down. We think we're at that point now. And I think that if the market starts to go down and they create even more river flow, or they simply continue what they're doing, the flow won't go where they want it to go. It's going to go into other asset categories. We think primarily it's going to go into gold and silver. Probably some of it will go back into Bitcoin at some point, though that's going to take a while to rebuild that market. And commodities are not temporary in the upside. They may look like it for the moment. Most commodities, they moved as an asset category, almost in synchronization, all exploding coincidentally: sugar, copper, oil. So the commodities all turned up coincident, meaning it wasn't peculiar to each market what caused the upturn. It was the monetary policy. And if the stock market wobbles now, it becomes a threat, that monetary policy is going to continue. And we still think it's going to go into the freshly upturned commodity category. Because when we measure commodities like the Bloomberg on an annual momentum basis, it only just broke out. And usually annual momentum trends, when they turn, last for a handful of years. For instance, the last time we made a major turn in the Bloomberg was the top in 2011, coincident with gold, with quite a few years of downside. We think the same is going to be true on the upside, except it may be a little more compressed this time. Instead of taking 5 years, it might get something big done in a couple of years. And we're also of the working assumption that this trend that's about to emerge in these categories is not going to be incremental. It's going to be compressed because of the very nature of what's underlying it, the monetary policy, such that gold at some point, which has been, for example, an incremental upside, 1054 low in 2015, went to 2000 double basically. But if you look at it carefully, it really never went crazy. It would have a couple $100 burst and a pullback and fool everybody, and then a couple $100. It was always sort of a staircasing ladder effect. So it was incremental. It's going to be an interesting year and a half, we think. That a lot of stuff is going to move big time. But frankly, I don't want the longs too enthusiastic until we get into that chaos period where it's going vertical. Then they can get enthusiastic, if you know what I mean. Okay. This time, we don't think the stock market's going to crash. We think it'll go into a normal bear market. And I think you'll see the opposite markets, the alternative markets rise. I think we're headed for a crisis that will create doubt about whether we want a Fed. And we may even have comments from Europeans, Germans especially, about whether they want the ECB. In other words, this stuff hasn't worked. Nixon cut us off, the dollar off from international exchange for gold in 1971. And, have the events over the last 50 years really been that good in terms of stability and so forth? Has the central bank really kept things copacetic? Or has they contributed to the boom-bust cycle, which I would argue they're the main contributors to the boom-bust cycle? By creating too much one way, they create too much the other way. I think there's going to be some intellectual doubt from various parties about, hey, this hasn't worked. And we may even have examples from what a world we live in, where former communist countries, China is no longer really communist, the party rules, but it's not what it was under Mao, or even Russia, where you have currencies backed by gold, or they're non-fiat currencies to some extent, meaning the government doesn't have control how much money there is. Even Bitcoin, it can only grow so much. It's very finite compared to what the dollar can do in terms of the quantity of units. I think this next crisis we're headed for will create a wave of intellectual doubt among academicians, economists, and possibly even some ex-Fed people who say, hey, this really, it hasn't worked out. We need some other way to have money. We don't need top-down control.